Most beginners hear 15% dividend yield and immediately assume it's a scam, but that instinct is costing them real monthly income. Some of the most overlooked ETFs in Buffett's broader investment universe are quietly paying out yields that most savings accounts won't touch in a lifetime. The problem isn't that high-yield dividend ETFs are fake, it's that beginners don't know how to read them, so they walk right past them. By the end of this video, you'll know exactly how these ETFs generate a 15% yield, what the cold hard math looks like on a real portfolio, and whether this strategy can actually replace a portion of your paycheck. Here's exactly what we're going to do in the next 10 minutes. We're going to break down how a specific category of dividend ETFs, ones connected to the investment principles Buffett himself has championed for decades, can generate yields in the 10 to 15% range without being traps. We're going to look at the real checks you need to run before trusting any yield that high. And then we're going to run the actual math on a $10,000 starting position. Here's the number I want you to hold in the back of your mind. $147,000. That is the projected value of a reinvested, compounding position built around a 15% yield strategy, starting from $10,000 over 25 years. That number might sound impossible right now. By the end of this video, it won't. We'll walk through exactly how it builds, year by year, dollar by dollar. But first, you need to understand why most people never get there. And it has nothing to do with not having enough money. Here's the shift that changes everything. Most people look at an investment and ask one question. Will the price go up? That's the wrong question, at least for this strategy. The right question is, will this asset keep paying me regardless of what the price does? Because when an ETF pays you a 15% yield, you're not waiting for someone else to decide your asset is worth more. You're getting paid to hold it. The asset works. You don't. That's not just a nice idea. It's a different relationship with money entirely. Most of us were raised to trade time for income. You show up, you get paid. You stop showing up, the income stops. Dividend income breaks that loop. Your money shows up so you don't have to. And the engine that makes this strategy genuinely powerful isn't just the yield. It's what happens when you take that yield and immediately put it back to work. Every dollar your ETF pays, you buys more shares. Those shares pay you more dividends. Those dividends buy more shares again. That loop, compounding through reinvestment, is the actual engine. The 15% yield is the fuel. Compounding is what turns the fuel into something that eventually runs on its own. I break down income strategies like this every few days. The math, the mechanics, and the mindset behind building real cash flow from dividend assets. Subscribe so you're here when the next one drops. Now, before we go any further, I have to tell you the mistake that wipes people out in this space. Because it's the first thing beginners do, and it's the most expensive habit in dividend investing. They see a 15% yield and they buy it. No questions, no checks. Just 15%, that's incredible, I'm in. And I get it, the number looks incredible. But here's what that number can actually mean. Sometimes a high yield exists because the ETF or fund has held up its distribution while the share price has fallen significantly. The yield looks massive because the denominator, the price, collapsed. You're not getting a gift. You're buying into something the market has already punished. This is called a yield trap. And it's everywhere in the high yield space. The fund keeps paying out distributions, sometimes even distributions larger than what the underlying assets are earning, just to maintain the appearance of income. That's called return of capital. And when it's used inappropriately, it's essentially the fund giving you back your own money and calling it a dividend. Your principal erodes, your income shrinks. And eventually the distribution gets cut anyway, usually right after a wave of new investors bought in chasing that big number. The yield number alone tells you almost nothing about whether the income is real, sustainable, or growing. It's a starting point, not an answer. So here's how you actually evaluate a high-yield ETF before putting a dollar in. Run these checks in this order. First, is the yield real or inflated by price collapse? Pull up the 5-year price chart. If the ETF has lost 30, 40, 50% of its value while the yield has climbed, that's a red flag, not a reward. Second, What is the distribution source? Is the fund paying you from actual income generated by its holdings, option premiums, dividends, interest, or is it returning your own capital? Look for the fund's breakdown of ordinary income versus return of capital in its annual reports. A legitimate high-yield strategy earns its payout. A yield trap pays you with your own money. Third, is the distribution stable or erratic? Look at the last 12 months of payments. Are they consistent? Have they been cut? A fund that slashes its distribution mid-year and then quietly rebuilds it is not stable income. It's a roller coaster dressed up as a paycheck. Fourth, does the strategy have a mechanism that actually generates high income? This is where the Buffett adjacent category gets interesting. There is a class of ETFs, covered call ETFs, also called buy right funds, that generate income by selling options contracts on top of dividend-paying stocks. The underlying stocks are often the same blue-chip, quality-focused equities that align with Buffett's long-held investment principles: durable businesses, strong cash flow, consistent earnings. The income doesn't come from nowhere. It comes from a defined, repeatable strategy. Run those 4 checks on any high-yield ETF before you invest. If it passes all 4, you're looking at real income. If it fails even one, slow down. Let me show you what this looks like in practice with 2 real scenarios. Example 1. An ETF is yielding 14%. Your first instinct is suspicion, and that's good. But you run the checks. The underlying portfolio is built on large-cap, dividend-paying U.S. equities. The income is generated primarily through a systematic covered call writing strategy, meaning the fund sells options contracts on its holdings and collects the premium as income. The price has been relatively stable over 3 years. The distributions are paid monthly and have been consistent. Return of capital as a percentage of distributions is low. This is a 14% yield that earns it. It passes every check. Example 2. An ETF is yielding 11% and has a long track record, but you look at the 5-year chart and the price has dropped nearly 45% from its peak. You dig into the distribution history and find that in 2 of the last 4 years, more than half of the dividend was classified as return of capital. The fund's total return, price change plus income, has been deeply negative over a 5-year hold. The 11% headline yield is essentially the fund recycling your principal back to you with a bow on it. This is the trap. Same number, completely different reality. This is why the number alone means nothing. Context is everything. Now let me show you how a smart high-yield portfolio built around these principles actually gets structured. Think of it in 3 layers. Layer 1. The stable income foundation. This is your covered call ETF exposure on broad quality equity indexes. These funds own the kinds of companies Buffett has always respected. Businesses with pricing power, strong balance sheets, consistent earnings. The covered call strategy on top generates the high income. This layer is your primary yield engine. It's not flashy, it's reliable. Layer 2, the dividend growth anchor. Not every position needs to be maxed for yield today. A portion of the portfolio sits in funds that own companies with long histories of raising their dividends every single year. 10, 20, 30 consecutive years of increases. The current yield on these might be 3 or 4%. That sounds boring next to 15. But in 10 years on your original cost basis, those raises could push your effective yield on that position significantly higher. This layer builds your future income floor. Layer 3, the real asset income kicker. This is where real estate investment trusts and infrastructure-focused funds come in. These assets are legally required to distribute the majority of their taxable income to shareholders, which means they structurally produce income regardless of market sentiment. They add diversification to your income source and often behave differently from equity-based funds in volatile markets. 3 layers. 1 goal, monthly income that isn't tied to whether you showed up to work today. Let's talk about what $10,000 actually earns in year 1 at a blended 15% yield. That's $1,500 a year, $125 a month. I'm going to be completely straight with you. That's a phone bill. That's not quitting your job. That's not financial independence. If you came here expecting a shortcut to replacing your salary overnight, I won't dress this up. $10,000 at 15% gives you $125 a month. And I'd rather you know that right now than feel deceived later. But here's the reframe. That $125, if you reinvest every cent of it, doesn't stay $125. The seed looks small because you're looking at it on day one, not year 15. The tree takes time. Every dollar reinvested buys more shares. More shares generate more income. More income buys more shares again. The math stops being linear and starts being exponential. 125 a month today is not the story. What happens to that $10,000 over the next 2 decades? That is the story. Here's a stat that looks bad but actually isn't. Covered call ETFs, the primary engine behind many of these 15% yields, tend to underperform in straight-up bull markets. When the stock market runs hard and fast, these funds lag behind simple index funds. And beginners see that and think, why would I want a fund that underperforms? Here's why. You are not optimizing for price appreciation. You are optimizing for income. When the market rips upward and your covered call ETF only gains 8% instead of 20, you still collected 14 or 15% in income distributions. Your total return, income plus price, is often competitive. And more importantly, that income showed up in your account whether the market was up, sideways, or slightly down. The underperformance in a bull run is the price you pay for income that doesn't depend on a bull run. For someone building a paycheck from their portfolio, that trade-off isn't a weakness. It's the entire point. Now let's pay off the number I planted at the beginning. $10,000. 15% yield. Every distribution reinvested. No additional contributions. Here's what the math looks like. Year 1, your portfolio generates $1,500 in income. Reinvested, your position grows to $11,500. Year 3, you're at roughly $15,200. Year 5, just over $19,500. The compounding is starting to show. Year 10, approximately $34,000. Your monthly income from that position, without touching the principal, is around $425 a month. That's not a phone bill anymore. That's a car payment, a utility bill, a grocery run. Real money that shows up whether you work or not. Year 15, $60,000. Monthly income approaching $750. Year 20, $105,000. Monthly income crossing $1,300 per month. Year 25, $147,000. Monthly income, over $1,800 a month from an initial $10,000 investment without ever adding another dollar. $147,000. $1,800 a month from $10,000 and the discipline to leave it alone. That is not a pitch. That is arithmetic. The strategy works because compounding works. And compounding at 15% is among the fastest legitimate versions of that engine available to a retail investor today. Now here's what I want you to think about before you leave. Everything we covered today assumes you start with $10,000 and never touch it. But what if you started with $25 a week instead? A coffee budget? A subscription you forgot you were paying for? That number, compounded through the same strategy over the same timeline, turns into something that will genuinely surprise you. But there's something else I want you to watch because the math is only half the equation. The other half is what happens inside your head when your portfolio starts paying you. Why some people see their first $50 dividend and immediately reinvest it, and why others pull it out and spend it. That behavioral gap is what separates the people who build real income independence from the ones who stay stuck. I made an entire video on exactly that psychology. It's called The Psychology of Dividend Investors Who Escaped the Rat Race. Watch that next. It will make everything we covered today click into place. This video is one piece of an ongoing system. Every video builds on the last. Stay in the series and the picture gets clearer every week. I want to know where you're starting from. Drop your answer in the comments. If you invested $10,000 today into a 15% yield strategy and committed to reinvesting every distribution for 25 years, what would be harder for you? finding the 10,000 or leaving it alone long enough for the math to actually work.